Good morning. It is November 17th, 2025. I am Herb Morgan, Senior Managing Director and Chief Investment Officer for Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. If you'd like to follow me intra week, and I of course encourage you to do so, go to LinkedIn, type Herb Morgan, and add me there. If we have something to say between these weekly commentaries, that's where it will be. The presentation you're seeing and or hearing in the case of audio podcast only is prepared by us. It is designed to be used by you. It doesn't matter who you are. There are no investment recommendations. Nothing contained in the presentation should be treated as advice. No recommendations for the purchase or sale of any securities. Everything is informational purposes. The views expressed, to the extent that there are views, may differ from the views of CFIA's parent, affiliates, or other portfolio managers at the firm. Past performance, no guarantee of future results. Let's get into it. It was I'm going to call it a down week, right? Small and mid-cap stocks down about 1%. Right there at the zero line was the S&P 500. Interest rates up a couple of ticks. You can see it in the ag and in the 20-plus year Treasury index, with both high yield and floating rate debt just kicking along. If you look over here on the right, the year's getting close to being over. We're in the 11th month. Everything looks pretty good, but small and mid-cap stocks really lagged. International and emerging markets really outperformed expectations, and I think significantly outperformed their fundamentals. What looks about right to me is large cap US, led by big cap tech, big spending, hyperscalers, Mag 7, all of that stuff is alive and well. Let's get into last week's data. Still a lot of data missing because of the government shutdown. That shutdown is now over, and we're going to expect a lot of data to be coming back online, which will then give us sort of more clarity to what we think the Federal Reserve might do in December. Let's start with the National Federation of Independent Businesses Small Business Optimism Index. Fell a little bit, 98.8 to 98.2. You can see it right over here on the right. Earnings decline on weaker sales, higher costs. There it is. It's still, whether it's the consumer or businesses, it's cost of living. And their overall optimism fell just a little bit. Weekly claims for unemployment, what is that, the fifth week now? Fifth or sixth week, I guess. Sixth week there with no data there. The estimates are around 225. I expect that's kind of the number when we get those numbers. The CPI, Consumer Price Index, also delayed by government shutdown. A lot of concern here, right? When we get the CPI and the PPI, which I think we're going to get this week, when we get those and we get those caught up, that's going to give the Fed some of the information that it uses and needs to determine whether or not they can cut on December 10th. So it would be great to get caught up on all this data. That includes retail sales, also impacted by the shutdown. But I mentioned at the outset that the shutdown has ended. So let's talk about what's next and what happened. What was the deal, right? There's always a deal. After 43 days, funding to run the government was secured just for the next 6 weeks via a CR, or a continuing resolution. But they also added full year appropriations through September 30. Remember, our calendar year, our fiscal year rather, for the U.S. government is through September 30th. They fully appropriated for military construction, veterans affairs, and agriculture-related programs. So those are now taken care of through the end of the fiscal year. They also got back pay for the workers that were furloughed. We always knew that would happen. And halted a halt on new layoffs through January. The SNAP program, Supplemental Nutrition Assistance, funded through the fiscal year, and WIC, Women, Infants, and Children, also funded through the fiscal year. The sticking point in the whole thing was subsidies for health insurance, sort of a backdoor move to socialized medicine. If you're below a certain income level, you apply online at the exchange, you pick a plan, and it tells you how much it costs, then it tells you how much the government is paying on your behalf, and then you pay the delta or the difference. Democrats wanted bigger ACA, Affordable Care Act subsidies. What they got out of that was not the subsidies, but a promise to bring them to the floor for a standalone vote in December. That will be voted down for sure, but they want to use that as political fodder so they can say in the 26 elections, do you see the Republicans voted to take away your health care? From the Republican perspective, they're saying, hey, you're not controlling who's all getting this. There are some folks that perhaps should not be getting this, that perhaps are not eligible. And oh, by the way, we've got a massive deficit debt, and we just can't afford it. Those are the two sides of that argument. Now, all eyes are turning to the Federal Open Market Committee meeting on December 10th. As of now, Bloomberg Terminal tells me there's a 43% chance of a rate cut. Well, that's about 50-50 in my book, pretty darn close to it. I think once the government is fully reopened and we get the delayed economic data and the market synthesizes that economic data, we will see a more clear picture of what they plan to do with rates. If I had to guess, I think they're going to show weakness in the labor market and, unfortunately, sticky high prices, which puts us right where we were before this all started. My bet is the Fed ignores the inflation and focuses instead on the full employment. So we do get another 25 basis points on December 10th, but I'm not betting the farm on that call at this point. The other thing that's happened last week, if you missed it, is the troubles in private credit continue to mount. And I guess this is me, partly because I, lived through and managed your portfolios for many of you through 2008. It's a very, very difficult time, and this was a credit-related contagion. I don't know if this one's as big. I don't know if this one will happen. I don't know if it'll be as impactful. We don't know any of those things yet. But we do know that the concerns are continuing to mount. A big alternative investment firm called Blue Owl blocked redemptions from one of their earliest private credit funds last week. They said, well, we're merging it with another one of our funds, a larger fund. We're going to merge the two together. Well, that's fine. So they might want to block the redemptions for a month or two. I kind of understand that. But investors are being required in this merger to take a 20% hit to their net asset value. So if you had $100,000 in the portfolio, you now have $80,000 in the new merged portfolio. Private credit has been marketed as low risk, high quality. It is none of those things. It has grown, is largely unregulated, and it is one of those things that if it gets unwound can have a contagion effect throughout the other risk markets, including stocks, bonds, crypto, you name it. Out of Australia, the regulators there reported concerns as the sector has grown 5x to $200 billion in the last decade. Moody's here says that U.S. bank exposure, so banks regulated, but they have exposure to private credit, is now up to $300 billion, makes up over 10%, over a tenth of all bank loans, and that's triple what it was a decade ago. The IMF, International Monetary Fund, issued a report that last week where they cautioned that any downturn in private credit could lead to a difficult place. This is that reference to possible contagion. For the most part, though, the industry says no systemic risk, largely contained. We don't see it branching out, but with high multiples, it could easily be the impetus for some sort of market correction. Okay, we're just about done with the earnings quarter. 460 names have reported. Average earnings surprise here. We're looking at almost 7%. So very good. 376 companies beat, 68 failed to beat, 14 right in line with expectations. Plenty of economic data this week as we get back to government data releases. We've got New York State manufacturing, not a government report. We've got that today. Import-export prices, industrial production utilization on Tuesday, along with housing sentiment. Fed minutes from the last meeting, from the October meeting will be due out Tuesday, tomorrow, Wednesday. Then we've got jobless claims. We're back, hopefully. It looks like 225 is the number. Philly Fed, home sales, and the jobs report we did not get on the first Friday in November. looking for only a 50,000 ad. Unemployment unchanged at 4.3. S&P Global's manufacturing and services PMIs for November coming out on Friday, along with consumer sentiment. Thanks, everybody. I'll be back to you again next week.